Welcome to a podcast produced by the Edison Group. The market is often much less knowledgeable about the company's equity story than its management team might expect. Edison fixes that knowledge gap with one elegant solution, Investor Relations 3.0. Using an integrated program of research, marketing, and direct investor engagement, we accelerate, widen, and magnify the market's interest in a company's investment case. I'm Milosz, and I'm a Director of Investment Companies Research at the Edison Group. One of the companies I cover is Princess Private Equity Holding, an investment company focused on direct private equity investments managed by Partners Group, one of the top-tier players in the sector. November was a quite rough ride for the company's shareholders, as its share price fell around 16% in the first week of the month in response to the suspension of the company's second interim dividend. The company's shares now trade at a discount to last reported net asset value of more than 30%. In this podcast, I will examine the factors which led to the company's unexpected decision. Under the current objective, the board intends to maintain a dividend at around 5% of opening net asset value in each year, paid out as two interim dividends. The company was able to deliver this targeted yield over the last 10 years to 2021, except for the slightly lower yield of around 3% year of 2020, when Princess decided to cautiously reduce the level of one interim dividend. Princess started 2022 with a high liquidity position following last year's exits, most notably the disposal of Global Logic, holding 135 million euros in a portfolio of floating rate senior secured loans, which it temporarily invested in back in the second half of 2021. As an alternative to euro deposits, which offered a negative rate back then. This represented 13% of its net asset value as at the end of 2021, so quite a substantial liquidity reserve. On top of this, the company had 55 million euros in undrawn credit at the end of 2021. In June this year, it paid a dividend of 38 euro cents per share, on track to meet its target of 5% on opening NAV. So, what happened between June and November? Well, as the year progressed, the company's liquidity at the holding level became increasingly strained, especially towards the end of the third quarter, due to three main factors. Firstly, the strong appreciation of the US dollar against the euro, which resulted in around 60 million euros in cash outflows for the company's currency hedges in the first 9 months of 2022. This is because roughly half of the company's portfolio is denominated in US dollars, and around 90% of this is hedged to the euro. Secondly, the weakening activity across the global M&A markets translated into more limited private equity exits, and therefore Princess received only 8 million euros of realization proceeds in the third quarter, excluding redemptions of the above-mentioned senior loans. No major realizations from the US dollar-denominated portfolio meant that, while the strengthening currency resulted in revaluation gains before hedging, these remained unrealized, while the corresponding markup on the hedge instruments required additional margin deposits. Finally, Princess spent quite a large amount of more than 70 million in the third quarter on new investments, which were largely agreed a few months earlier. These three factors created a liquidity squeeze, which in the third quarter was covered by senior loan redemptions of around 25 million, as well as drawdowns on its credit facility of around 58 million. However, as the remaining senior loan balance declined to around 50 million euros, while the company's credit line was more than 90% utilized at the end of September, the board announced the prudent suspension of the second interim dividend for 2022 to preserve capital for potential further cash outflows related to FX hedges in the event of further US dollar strengthening, as well as other cash outflows, such as capital calls on the company's investment commitments and ongoing charges. Here, it is worth keeping in mind that Princess is a direct private equity company rather than a PE fund of funds, which means that it does not pursue an overcommitment strategy. Out of the total outstanding commitments of around 103 million euros at the end of September, Princess considers only 35 million euros as likely to be drawn. As the company also paused any new capital allocations to new investments starting from July-August, The dividend suspension allowed Princess to amass liquid resources of 88 million euros as at 18th November, a quite sizable safety margin. On top of this, the company is contemplating a moderate upsizing of its credit facility and potential changes to its FX hedging arrangements, which could further support its liquidity. It is also worth noting that the US dollar depreciated against the euro in November. Assuming no further significant strengthening of the US dollar and a normalization of the exit environment, Princess expects to resume dividend payments next year. At this stage, these preconditions are somewhat difficult to predict, given the uncertainties around the peak Fed rate, as well as the still muted M&A activity. On the other hand, if we look at Princess's private equity portfolio itself, it has fared quite well so far in 2022, with a moderate 5.3% decline in NAV total return terms to end October and a positive 3.7% development in Q3 alone. In general, the greater resilience of valuations across private equity portfolios compared to public markets is partly due to technical factors, which smooth out the portfolio valuations of listed PE companies such as Princess. I discussed these factors in more detail in several of my recent research notes on listed private equity companies. However, I believe that the portfolio resilience in case of Princess was also supported by sector mix, as the company offers investors high exposure to the healthcare sector, 21% of portfolio value as of September, including several healthcare service providers, and also a meaningful allocation to IT, 12% of portfolio value, mostly in enterprise software companies, and childcare/education, which made up 7% of its portfolio. This may help the company's portfolio withstand a worsening macroeconomic environment. Partners Group focuses on driving resilient growth underpinned by transformative themes such as digitalization and automation, new living, and decarbonization, as a form of defensiveness in its portfolio companies. This is also illustrated by Princess's new investments completed in Q3, which include, among others, a pan-European software services provider, a digital transformation services provider, an environmental health and safety and ESG software as a service platform, and an independent insurance broker. Thanks for listening. Please read our full research report at www.edisongroup.com.